Hi, and welcome to a new episode of The Value Creators. Today's guest will be Francesco Aldorisio. He is Head of Private Equity Investments at Unigestion. Welcome, Francesco.
Thanks for having me, Stefan. It's a pleasure to be here.
The same for us. Could you tell us more about Unigestion?
Unigestion, it's a Swiss headquartered independent asset manager who's active for more than 50 years in equity and private equity. And we are 50 years old, if you want. And it's important to say we stay fresh and young in our minds, because we know that, especially in this business, investing for the long term in companies, for the mid-long term, you learn every day. But still, we have in our big backpack a lot of experiences. We have all the scars of the crises, and we take them with us. Our investment committee members are in the business for more than 30 years, each of them. And so we bring that along in our investment activities, decision making. Unigestion has nearly $20 billion on assets under management. This is in equity and private equity. Private equity is the biggest of our platform with nearly 11 billion assets under management. And we like to think of it as the largest global platform for mid-market investing. We are fully focused on mid-market, and we only do private equity. No infrastructure, no real estate, just private equity. And we have a global team. So our investment team is based across the globe. We have offices in Asia, in Europe, in North America. We have a global mandate from our investors because we invest for them across the globe. And we have a global investor base, so our investors spread from Europe to North America all the way to Australia.
This is a very impressive legacy, and I'm persuaded that more to come. You mentioned the different offices. You have a presence in Luxembourg too?
We have launched our first Luxembourg fund in 2005, and so we are active in Luxembourg for nearly 20 years. And we, over the years, expanded our activities locally. And I'm very glad that today, here in Luxembourg, we can benefit from a deep and broad network of service providers who support us all the way from fund management to AFMD to trustee and auditors. And we have been growing our activities alongside all the ecosystem, and we look forward to keep growing with Luxembourg.
And in this context, could you explain us concretely how you create value?
We call our value creation strategy across our funds the triple alpha strategy. The first alpha comes from covering deeply the mid-market, because we know that there's the opportunity there to do a superior return without taking additional risks. The second alpha comes from choosing investments that are driven by the right long-term investment themes. And the third alpha comes from our own value creation of being in the market for a very long time, having a huge network, been able and having the track record to select the right investments at the right time with the right KPIs, and having the ability to deploy the right resources to create then value in the specific investments.
This sounds like a very robust methodology. Could you share also, Francesco, a few examples where you applied that and created value within portfolio companies?
Yes, I'll do that. Let me before explain you the first alpha, so we take it top down. The first alpha about being in the mid-market, there's researchers that prove that the mid-market can deliver a higher return. So first and second quartile funds in average deliver a better return than larger funds. So we start from playing in the right segment of the market. In this segment, we apply the second alpha, which is choosing the investment themes that we back since a very long time, which we always review, but they tend to be pretty stable as they're long-term trends. For example, we believe very much in energy transition as a theme that doesn't touch just the energy industry, but has touch points and consequences and defines megatrends in all industries nearly. So we like to back companies that provide services or products that support the value chain in evolving along those themes. which is very important because it makes sure that the companies we invest in or the projects we back are long-term growing, which means that typically when we are in the company after 3, 4, 5 years, or we have invested in a secondary transaction after 4 or 5 years, the assets are realized while they're still growing. So we don't depend on general economic cycles for realizations or for creating value in the companies. That's very important. That's where we start. Now here, with this in mind, and back to the third alpha of our companies and how we create value there, it's very important to put this in perspective of the lower mid-market. We're talking about companies which are for the first or the second time, at most, in the hands of a professional investor, which means that there is a lot of active ownership that can be put at play, a lot of value creation. Just think that most of the times when we or our partners, when we invest in their funds, we are entering in a company and find very good people, but typically limited spread in the management team, with the ability that then we have to increase the skills, bring in new people, increasing the size and the depth of the management team in order to enable the company to attack more growth options, attack new markets, create new products or services. And this is typically the biggest value creation in our funds, what you see as a result. But it starts from this dynamic of adding managerial power to the companies. And that is typically also then realizing in the fact that we buy at a price measured as multiple of EBITDA that is typically lower than the multiple we get when we or our partners sell the companies. This is possible because typically, back to the entry, at that time when we or our partners again back these companies, the trade buyers, the strategic buyers, have difficulty in buying a company which typically has a management team of 3-4 people, have limited reporting systems, has very limited compliance and all the processes around many different topics. While when we sell, of course, having increased the managerial power, as I call it, we have a company which is ready to be in the hands of a strategic buyer, and therefore you can imagine the price at which then we can sell the company is much more interesting because the strategic buyer is a potential buyer, and that brings a totally different dynamic. Now, going to some examples, and allow me to take a step back quickly for the third alpha. It's very important to mention how we get to the investments. I always like to tell during our investment teams when we discuss with my colleagues investments that we want to invest, and I'm glad that they follow me on that, we invest in companies that we don't get to know through the pitch book. We invest in companies that through our partners or through our funds or through our network, we already know, or we already have an information because we have an ownership in a competitor or in a company that has a supplier to them, and so on and so forth. So we have a lot of touch points. It's very important to think we have done more than 600 fund investments. So these funds have then done 10, some 20. So underlying number of companies and the universe of knowledge we have is very high. We also have done more than 200 secondary transactions over the years and nearly 150 direct investments. So the network and the knowledge that we have in order to gather information on companies when they come as a viable investment is immense. And actually, we have structured all of that through an artificial intelligence-driven assessment tool that we call PEPPER, Private Equity Performance Prediction Engine, which we use every day in our activity, and it takes the benefit of more than 500,000, so nearly 500 million data points, meaning that when we run our portfolio monitoring quarterly on all the portfolio and the underlying companies throughout our funds, we register all those data digitally, and then those data are run through an artificial intelligence-driven algorithm that our colleagues have created that give us the proxy of the potential return to be expected on a direct investment, on a fund investment, on a secondary, Of course, we don't let the machine decide. We still, but we take a lot of benefits from having this interaction with the machine, and that is very telling because typically it also tells us what are the aspects, what are the data points like EBITDA margin or sales growth, which are positive contributors to return, and what are the negative ones. So we are able to take the pulse of the artificial intelligence on what should be also our focus in due diligence. This we do very much.
And it's always very impressive to hear about how long you have monitored a firm before, which data points you were kind of checking before, even you applied an AI in your case. But that's always kind of where people think investments, they happen quickly, etc. No, there is a whole professional preparation behind before you push the button.
Very much. Thanks for that. It's a very good point. I see the artificial intelligence-driven tool we have more like a very digitalized way to action knowledge, network, and know-how. So typically you have in the team meeting or in an investment committee someone saying, oh, but hold on, I know the company similar to this one is not in Norway where we're looking for that. It's a competitor in the US. Everyone's scratching their head. There you have it. You push the button, you have the list, you make a phone call, and we are really just through that, we are one phone call away from the top reference, because this could be the CEO of a competitor or of a supplier, as I said before. So you can really digitalize your network and use the intelligence, because at the end, investment is about using your experience to judge the potential of a new opportunity, and this machine learning driven process is very powerful in that respect. So I think over the years, again, I don't think in 5 years I will be useless as an investment professional, but there will be a lot of support from these tools, and we try to stay at the forefront.
And where did you apply then a little bit this recipe now with concrete cases?
Yes. So the first example, actually two companies I like to talk about is telling about how we came to them through a very long time developing relationships. So in 2008, 2009, we invested in a company called Robur from our direct fund, which is a roll-up play into the industrial service market in Germany. Actually, the company then focused more and more into the industrial services to renewable assets like wind, solar plants. It had a very good momentum. We sold the company for a very good return just last month. But the interesting story here is that when we invested in that company, we were working together with a so-called deal-by-deal fund managers, fundless sponsors, so-called. So they were gathering money from family offices and some institutional investors like us to back this company like Robur. And then they wanted to launch their own fund to have a blind pool of capital to be a standard private equity play. We backed them with our emerging manager fund. We have a primary fund of fund. It's an emerging manager. We back Fund 1 and Fund 2. We are among the few. I think the only one who does it globally. And we backed what they call then Green Peak, the name of the manager that they use. And through that investment, because we were the very first one on the table, having seen how they work in companies, we could get the benefit of being the first at the table to give them a check. We have negotiated the right to invest alongside them on what we would then believe to be the more interesting company. So we used that right to drive alongside them two investments. One is called Academia and one is called Certania. These are two buy and build plays, as Robur was, or roll up or buy and build. So identifying first with the help of some industry experts, industries where fragmentation of the industry is so much that there is the crying for an industry leader that consolidates the market and creates the natural consolidator. Private equity has a role there, and we back many of these projects. So Academia was about doing this in the hematology, pathology, and the human genetics laboratories, which were very much, there again, data-driven. So as you can imagine, if you cross the blood analysis with the hematology or the pathology analysis, you can have much stronger advice to the doctor and the patient. You need to do that at scale. If you have two laboratories it's difficult to do it. If you have 50, 100, you can afford to invest to do that. And actually, this company is at the forefront of also using data there.
Very powerful, yes.
That company consolidated the market, and we realized the investment a couple of months ago, after only 2.5 years. And we nearly did 3 times our money and an IRR of scratching 150%. Again, great result. It started in 2008 with investment in Robur and then through the fund and the companies again. So it's about using your network to get there. The other company, Setania, did very similar projects and even as interesting results. We also sold that company recently, a part of the company. The valuation is 5 times what we initially invested. IRR is more than 200%. There we liquidated half of our shares to a new investor, and we kept some shares because we see further upside. That was a roll-up play into the testing, inspection, and certification, also laboratories for industrial applications. Similar concept, similar way to create value by consolidating. What's very important there, the trust in the partner that analyzes the industry, having at the back people that have been in the industry for 10, 15 years and says, this is a viable niche to do the project.
This is a very important proof of the power of networks and then also of human intelligence combined with right tools. And finally, then again, people's business.
Yes, yes.
Excellent, Francesco. Anything else you would like to add on top?
I think maybe, if you allow me, one last. We have also launched, I didn't mention, climate impact strategy.
Okay.
For us, this is nothing new, but in a sense that we had the first ESG-oriented private equity mandate from actually a Swiss client of ours already more than 10 years ago. So ESG is not a new topic for us, and Unigestion has always been at the forefront also on the public equity part of our investment activity on ESG topics, being an active investor. The Climate Impact Fund we launched is dedicated to achieve an impact as a result, but also financial result. It's both are very important to us. We don't give up anything on the financial return. And we have been applying ESG topics to our investments and creating value, back to your question, through ESG in our companies. An example of that is Kindred, which is a childcare business in London and the neighboring areas, of which we have been an active owner, leading the transaction in the last 5 years plus. And it's interesting to see how ESG is not a theoretical topic. It's very, very tangible. In Kindred, through expanding and empowering a larger management team, bringing as CEO an industry expert on board with us, we have implemented health and safety, we have implemented company well-being, employees well-being policies, environmental policies, and all of those have been key in having our employees happier and staying with us longer, having our customers who give us the benefit and the honor and the duty to take care of their children, being very and more happy about leaving their children in our facilities. And this is ultimately has driven revenues, margins, and we have a better company. So it's very, very aligned.
This is completely music to our ears. And now you have even approached a little bit the third interview series we also have, ESG Impact, the New Pioneers. So we know whom we can invite back.
I may have to come back.
Absolutely, with great pleasure. Thanks a lot for sharing all your insights, Francesco.
It was a pleasure, Stefan. Thank you very much.